So here's a problem from Chapter 5, and this covers basically learning objectives 1, 2, and 3. Okay, so what we're going to do, it says journalizing purchase and sale transactions. So journalize the following transactions that occurred, whoops, get that out of there, that occurred in September 2015 for aquamarines. No explanations are needed, so we don't have to write the explanations on the journal entries. Just the good old debits and credits. Identify each accounts payable and accounts receivable with the vendor or customer name. So we are going to put a little identifier after any time we put accounts payable or accounts receivable. We'll put a little dash and identify specifically who that is tied to. Okay, so I'm not going to go ahead. I'm not going to put the journal format. I'm not going to put the headers up here. We'll just go ahead and start. So we got September 3rd, purchased merchandise inventory on account from Shallon Wholesalers, $5,000, and it gives us the credit terms there. FOB shipping point means that the goods changed hands at the shipping point. So if there's any shipping expense, we are going to end up paying that. Okay, so but we haven't talked about that in this entry yet. So for this entry, we're just going to record the initial purchase. So that's going to be a debit to merchandise inventory for $5,000 and a credit to accounts payable. We will label that Shallon. Oops. Shallon, and that's $5,000. Okay, so that takes care of our September 3rd entry. Now, September 4th, it says paid freight bill of $80 on September 3rd purchase. So again, since we said that was FOB shipping point, the responsibility for that shipment started the second that it left the warehouse or whatever for Shallon. So we're paying for the shipping charges and any expenses if it gets damaged or anything on the way. Okay, so again, this just increases our merchandise inventory for $80 and credit to cash for $80. Okay, also on September 4th. Purchased merchandise inventory for cash of $1,700. Okay, again, we'll just select one of these. We got to change the number there. $1,700 of merchandise inventory is purchased. Debit to merchandise inventory, $1,700. And this is going to be a credit to cash for $1,700. Moving right along, September 6th. We have sold merchandise inventory to Hermosa Company, $6,000 worth on account. Terms, there's the credit terms, $215, net $35, and the cost of goods sold is $2,640. So first, remember this is going to require two journal entries. First, the one showing accounting for the sale, and then accounting for the inventory side. Okay. So on the sales side, we are selling on account, so that's going to be an accounts receivable, and we're going to label that Hermosa. That's going to go to $6,000. Then we're going to have, oops, I should put a DR in front of that. And we're going to have a credit to sales revenue. Whoops, for same amount, $6,000. And then the second half, again, needs to show that we are recognizing cost of goods sold and that also we're decreasing our inventory. So I'm going to have cost of goods sold as my debit, and that's going to be for $2,640. And credit is going to go to merchandise inventory for the same amount. Excuse me. Okay, so we got two journal entries to take care of that September 6th entry. So now let's move on a little bit here. Now, September 8th. Sold merchandise. Whoops. That was September 8th. Sorry. Skipped one there. So let me just cut and paste that one there. That was our September 8th entry. Our September 6th entry is this: return $500 of inventory from September 3rd purchase. Okay, so that's this purchase right here, and we need to return $500 worth of that. And like I discussed, and like your book discusses, that's just going to be basically a reversal of this entry right here. So we're going to have a debit to accounts payable, Shallon, for $500. And then we're going to have a credit to merchandise inventory of $500. Okay, so that takes care of that one. Now, moving on, let's take a look at September 9th. Let's get rid of these extra lines here. Save some space. Okay. 9th of September, purchased merchandise inventory on account from Thomas Wholesalers, $8,000. Terms are $210, net $30, and FOB destination. So we're not going to have to pay any shipping charges on this one. Okay, so this is going to be a debit to merchandise inventory in the amount of $8,000 and a credit to accounts payable, but now the account payable is going to be owed to Thomas for $8,000. Okay, so that takes care of that one. September 10th, made payment to Shallon Wholesalers for goods purchased on September 3rd, less the return and the discount. Okay, so that's the 10th, so September 10th. Okay. So our debit is going to be to accounts payable Shallon. Back in here. Oops. Okay, and we had this $5,000 here was the original amount. We returned $500 of that. So the entire account payable that we owe right now is $4,500. So we're going to want to cancel that entire $4,500 off. Okay. And then we want to look back up at what the terms were. So they were offering a 1% discount if paid within 15 days. So we're going to assume that we did pay within that 15 days. And that should give us a 1% discount. Okay, so you just calculate, well, you just look at this and say, well, 10% of this 4,500 would be 450, so 1% would be $45. Okay, we're going to get a $45 discount here. So our credit is going to be to cash first, and that's going to be 4,500 minus 45, so that would be $4,455. Okay, so that's a credit to cash for $4,455, and then we're also going to have a credit to merchandise inventory for $45. Okay, so that's basically again showing that our accounts payable is completely paid off. This is the amount we actually paid. This is the discount amount, so we want the merchandise inventory balance from this transaction to be the amount we paid, which is $4,455. The way that we do that is by taking $45 by lowering merchandise inventory by $45 to get to this amount. So that's what this credit entry here does. Okay, so that was September 10th. So now let's look at September 12th. And it says we received payment from Hermosa Company less discount. Okay, so let's see. We sold to Hermosa Company. We offered them a 2% discount. So we're going to receive cash. Okay. We're going to have, a debit for sales discounts. I'm putting the account titles in here just so we have them down before we actually calculate this out. And credit to accounts receivable, and that was Hermosa, and that was for $6,000. Okay, so we know that the accounts receivable is going to go down by $6,000 because that's what it takes to cancel that completely out. Okay, we know we gave them a 2% discount, so the cash we get is going to be 98% of this $6,000. And then our sales discount is going to be 2%, or in this case, $120. Okay, so cash will be $6,000 minus $120, so that's $5,880. Whoops. So debit to cash, $5,880, records the cash we received. Sales discounts will serve to lower our sales revenue from that sale, to have the net sales revenue reflect what we actually received, and then this will completely close out our accounts receivable. Okay, so September 13th. After negotiations, received a $200 allowance from Thomas Wholesalers. Okay, so Thomas Wholesalers was this one right here, and okay, so we had FOB destination on that one. So theoretically, the any goods damaged in transit would have been our responsibility. But in this case, they have allowed us to take $200 off of that, basically. So what we're going to do here is essentially the same thing that we would have done if we were returning $200 worth of inventory to Thomas Wholesalers. So we're going to debit accounts payable to Thomas for $200, and we're going to credit merchandise inventory for $200. Okay, so that takes care of the 13th. Moving on to this next column here, we're just going to put those over here. We have the 15th of September. Sold merchandise inventory to Jordan Company, $2,500 on account. Terms 110, and that instead of net 30, that's net end of month. So those are the credit terms, and then the cost of goods sold, $1,050. Okay, so we're going to debit accounts receivable, Jordan for $2,500. We're going to credit sales revenue for $2,500. We're going to debit cost of goods sold for $1,050. And we're going to credit merchandise inventory for $1,050. September 22nd. Made payment less allowance to Thomas Wholesalers for goods purchased on September 9th. Okay, so we already took that allowance out, so we don't have to worry about that. So we just have to pay what we still owe. to Thomas Wholesalers. So that would be, let's see, $8,000. We took $200 out, so $7,980. Okay, so we're going to debit accounts payable Thomas for $79.80. We're going to credit cash for $79.80. Okay. September 23rd. Jordan Company returned $400 of the merchandise sold on September 15th. Cost of goods sold for that merchandise was $160. Okay. So again, this was the transaction up here that this return occurred from. So we will have a debit to allowance for returns. And that's going to be for $400. A credit to accounts receivable. Jordan, $400. And then we'll just reverse the inventory effect of that. So we'll have a debit to merchandise inventory for $160. And a credit to cost of goods sold for $160. Okay, moving right along. September 25th rolls along. Sold merchandise inventory to Smith Sons for $1,100 on account that cost $400. Terms were given right there, $210 net 30 FOB shipping point. As a courtesy to Smith Sons, $75 of freight was added to the invoice, for which cash was paid by Aquamarines, which is us. Okay, so let's see. FOB shipping point means generally that they would pay the shipping costs. Okay, that was not the case in this scenario. So let's go over what we do have in this situation. So we have debit to accounts receivable Smith Sons $1,100. Credit to sales revenue $1,100. Then we have a debit to cost of goods sold for $400, and a credit to merchandise inventory for $400. Okay, but we're not done yet. We also want to recognize this $75 of expense. Okay, so we're going to have a debit to shipping expense for $75 and a credit to cash for $75. Okay, and remember, that's because when we are accounting for sending something to a customer, that does not get included in the cost of goods sold. That's actually separately tracked in the shipping expense. Okay, so now we have 26th of September. After negotiations, granted a $100 allowance to Smith Sons for merchandise purchased on September 25th. So we will debit cost of allowance, or could just call this allowances. This is that same account. Let's see, what did I call it up here? allowance for returns. This would all be the same account. Could be called allowance for returns. Could be called returns and allowance. Any number of things that this account could be titled, but we're going to go ahead and show $100 there. Whoops. Smith Sons for 100. Okay, that's what that one will look like. Since we're not actually receiving any merchandise back there, we won't have the merchandise side of that. The cost of goods sold is still going to stay the same. So on the 29th of September, we received payment from Smith Sons less allowance and discount. Okay, so we are going to have a debit of cash here for, let's see, they had $1,100 initially. After this transaction, they only owed us $1,000. The terms indicated a 2% discount, so 2% of $1,000 is $20. So we're going to have $980 in cash, debit to allowance for discounts, 20, and then we are going to have a credit to, accounts receivable, Smith Sons for 1,000. Okay, so that wipes out between this allowance here and this transaction here. That wipes out their entire account receivable. So finally, we have one more transaction, and that one looks like this. Received payment from Jordan Company, less return. Okay, so right here was the original Jordan transaction. Right here was the return. Okay, so they still owed us, after this return, $2,100 in accounts receivable. So we'll debit cash for $2,100, and we'll credit accounts receivable Jordan 2,100. And that completes this exercise of journal entries. Okay. So as you see, all I did was the dates, the debits and credits. I didn't do any descriptions on this one. Obviously, if you were using a formal journal and actually doing this in real life, you would want to, as these happened, enter a little description in each one. But since we're doing them, they're fresh in our head, we're doing a full month's worth at a time, not really necessary in this situation. Okay? So there's your final product of all the journal entries. And there's back to your question.